Unlike the scarcity-driven marketplace of 2022 through 2024, 2026 is defined by inventory normalization. New vehicle supply has reached healthy levels, and used inventory has stabilized. This glut is significant because it marks the return of a buyer's market. Consumers now have choices, forcing manufacturers to compete on merit rather than mere availability. Furthermore, the market is absorbing an influx of nearly 400,000 additional lease returns compared to the prior year. These shopper pools are being replenished just as the value proposition of traditional luxury brands is coming under intense scrutiny. The market is no longer constrained by supply chains, but rather by the consumer's willingness to pay a premium for diminishing returns.
In this environment, a category we define as smart premium has emerged. These are vehicles from mass-market manufacturers utilizing architectures and technologies previously exclusive to luxury marques. This is driven by platform modularity, allowing high-cost engineering solutions to be amortized across millions of units. A primary example is the democratization of sophisticated chassis hardware. For decades, the longitudinal engine layout with rear-wheel drive, essential for near-perfect weight distribution and uncorrupted steering feel, was the dividing line for luxury motoring. In 2026, manufacturers like Mazda have utilized modular large platforms to bring inline-6 engines and rear-biased drivetrains down market, directly challenging the driving dynamics of established European competitors at a significantly lower price point. Beyond platform architecture, the sensory gap, what occupants hear and touch, has closed significantly. The hardware tax on advanced noise, vibration, and harshness technologies has been essentially repealed. Features like active noise cancellation, which uses microphones to generate anti-noise frequencies, and acoustic laminated glass, previously reserved for flagship sedans, are now commodity hardware found in volume segment vehicles from Toyota, Honda, and Hyundai. Furthermore, the application of high-damping structural adhesives and the use of shared componentry with luxury sub-brands means a volume-branded vehicle often utilizes the identical bushings and sound-deadening materials as its premium counterpart, delivering.
The tactile experience has seen a similar revolution in material science. Mass-market manufacturers are aggressively targeting static luxury through the democratization of materials like Nappa leather on primary touchpoints. While a luxury vehicle may utilize higher-grade materials in areas rarely touched, smart premium vehicles focus resources where the driver interacts with the machine. Furthermore, heavy investment in haptics engineering means switchgear damping, the weighted click of a button or knob, is now engineered to mimic the resistance found in premium German vehicles. This eliminates the subconscious perception of cheapness that previously defined economy cars, further blurring the lines between segments.
While engineering quality converges, the financial reality of ownership has violently diverged. For the 2026 buyer, the purchase price is merely the tip of the iceberg. The total cost of ownership over a 5-year cycle is the deciding factor. Depreciation remains the largest cost. Luxury vehicles are currently experiencing steepened depreciation curves due to rapid technological obsolescence and a flood of off-lease units. Data indicates that a typical mid-size luxury SUV may retain only 40 to 45% of its value after 5 years. In contrast, smart premium competitors with lower entry prices and strong reliability reputations retain significantly more equity. Over a standard ownership cycle, this variance can amount to a $25,000 difference in retained value, effectively tax-free income saved by the owner. Further compounding the financial divide is the badge tax applied to insurance and maintenance. Insurance premiums have risen globally, but insurers price risk based on repair costs and claim severity. Luxury vehicles, utilizing complex sensor suites and laser lighting systems, carry significantly higher premiums because minor collisions result in exorbitant repair bills. Conversely, mass-market vehicles benefit from lower parts pricing and standardized labor rates at widespread dealership networks, rather than premium concierge service centers.
Over 5 years, the combined savings on insurance and routine maintenance for a non-luxury vehicle often totals between $3,000 and $5,000 compared to its premium equivalent. This market behavior is not solely a financial calculation. It indicates a sociological shift toward stealth wealth and brand agnosticism. The post-inflationary landscape has rendered conspicuous consumption less desirable for many affluent buyers. Driving a highly engineered, non-luxury badged vehicle has become a sophisticated signal of financial literacy and product savviness, an understanding that the premium is now in the hardware, not the hood ornament. The outlook for the remainder of 2026 confirms that the quality gap has closed, while the cost gap has widened. For the rational actor in this market, the strategy is now to buy the engineering and bypass the badge. For decades, the automotive market operated on a reliable axiom. Significant engineering refinement and superior sensory quality required a premium badge and a commensurate price tag. In 2026, that structural link has fractured. As the second quarter unfolds, the global industry has stabilized following the volatility of the early 2020s, reaching an equilibrium of approximately 16 million units. However, beneath this normalization lies a fundamental shift in the definition of value. We are witnessing a K-shaped consumption model. While ultra-high net worth demand remains insulated, the broader market faces persistent affordability barriers, with average new vehicle transaction prices having risen drastically over the last 7 years, compounded by sustained interest rates hovering near 7%. This economic pressure is the crucible powering a new market dynamic.